Thanks, Katie. Hi, everybody, and welcome to this special broadcast in which we will be discussing NDIS and SDA property investments. I'm Terry Ryder, founder and managing director of hotspotting.com.au, and my special guest today is Danny Buxton from 000 Property Group. Right now, we're all grappling with extraordinary circumstances. An area of Australian life is affected by the virus crisis, including residential real estate. And now more than ever, safety and certainty is important to property investors. So it's timely that we're discussing a form of real estate investment that can potentially provide a safe haven in turbulent times. Today I'm speaking to Danny Buxton from 000, one of Australia's foremost experts on creating homes designed for the needs of people with disability. Danny, welcome. Good to speak to you today on a subject that I think many investors are going to find very interesting.
Thank you for having me, Terry. And look, something that as a business, as we've started looking at probably the NDIS scheme, and particularly around that special disability accommodation that's available through the NDIS, is just not just the benefit it can have to us as investors, but really the social impact that we're having to, I guess, support and provide much needed housing for those people in probably some of Australia's most vulnerable people with those with challenges and disabilities. And it's interesting for me, as we've spent the last few years in this space, how many people you suddenly become aware of. It's like when you buy a car and you have a certain model of a car, all of a sudden you see that car everywhere, and all of a sudden there's a greater awareness of really how much more we need to do as a society to support those who are impacted in this way.
So we've kind of promoted this type of investment. This webinar is talking about a form of investment which is a win-win situation. It's a type of real estate that fulfills a social need, one for which there is a shortage at present, and it's also a type of investment where potentially the returns for investors can be higher than you can get anywhere else in residential property. So it's a very nice win-win situation.
Look, it is, as long as it's done correctly. And we'll talk about that a bit later on, about some of the risks and some of the issues that can occur for people who are, I guess, in this space. But I guess it's, and certainly very interested to hear what others who are listening in, what, their questions, their comments they might have around this. But we're seeing people who are potentially have come to us and said, hey, look, I'm in the process of doing this, and we look at their particular property option that they're doing, and there's a lot of red flags that pop up, and so you can, if you're not doing it right, you can put yourself at risk.
Yeah. We will talk about the importance of compliance and getting it absolutely right as we go through the discussion today, Danny. But perhaps we could kick off by you telling us a little bit about yourself and 000 and what you do, because you do a lot of things to help property investors, not just about disability-specific property. You do many other things. So perhaps a little bit of background, and then we can start to perhaps talk specifically about NDIS and SDA properties.
Well, 000, we've been 000 Property. We've been operating as DBA for at least just over a decade now, and just really working with mums and dads, people who are wanting to invest in the Australian market, but doing it probably a little bit different from most. We don't tend to hold stock. I guess we're kind of like a building broker, where we're out there, we're only dealing new property in that new space, and we go out to source options that are right for the client. Every client is different for what their needs are. For some clients, it's just looking for that investment that provides solid growth, but also really good solid yield. And so they're looking for that balanced approach, more of a passive investment. We've also got clients who are a little bit more active, where they're wanting to be a little bit more aggressive in their growth strategy. So they're chasing a property where we can, whether it be through doing a development, it could be doing a duplex where we manage the whole process. And in that process, in the development process, there's an equity uplift in the build. had a couple at the moment, which we've been doing, where we've seen over $150,000 to nearly $200,000 increase in value in that process, and it's still in an affordable manner for some people, particularly those who are in that used to the Sydney price market or the Sydney market.
Yeah.
We also, for us, we also look for those properties for those who are looking for yield and then a high yielding property. And I guess this is where the SDA, NDIS property works very well. But for most of our clients, they're just everyday people throughout Australia. We invest throughout Australia. Although with this particular project with the SDA Properties, our real focus is predominantly in southeast Queensland, more from that North Brisbane through to the Sunshine Coast area at the moment is where our real target is for those properties.
All right, and of course we're having this discussion against the background of extraordinary circumstances with the impact of the virus crisis working its way through every form of Australian life, including real estate. How are you finding it? We were talking earlier, and you were telling me that you're still getting lots of inquiry from investors. People are still interested in doing things in property investment.
That's correct. We are still getting inquiry. Probably has dropped off a little bit, but we're still having clients or potential clients or people interested contacting us. We've already had a couple of clients proceed just last week, and over the next coming weeks, we were working with a few clients in their strategy. But I think the important thing for people right now who are investing is to just really ensure where they sit financially, to really make sure that they're in that right position. They're comfortable with their work situation, their work scenario, and they've had that conversation with their lender or their broker, just so they really are being able to be strategic, but without just making a quick knee-jerk reaction into buying because they see an opportunity, but understanding and realising that property is also a long-term play. And we are of the belief, I know there are a lot of different comments out there, and I'd be interested in your thoughts on the media, because the media, actually I already know what your comments will be, but the media tends to be doom and gloom and everything's falling in. But our view is we do believe that as we come out the other end of these really challenging times, there is going to be a greater inquiry and a greater movement into property, because property just doesn't have that instability that we see in other markets, and everyone needs somewhere to live, and we're still, if you make sure those fundamentals are still there, from both population growth to the economic factors in that region and the fundamentals of development and growth, then obviously, it's still going to make sense from a long-term perspective.
I think if you look at the sum total of everything that's been reported in media, they do have a tendency to emphasise the negative and to embellish. Not that the current circumstances needs any embellishment from journalists. I mean, it's the most sensational story any of them have ever reported, the current circumstances. But if you look at everything that's being said by analysts out there, I think the vast majority of analysts are agreeing that real estate in times of crisis is a safe haven, that it always hangs tough, it stays solid. We saw that at the end of the 80s when the share market had a meltdown in Australia and elsewhere. We saw that during the global financial crisis in 2008, and the following year when real estate was predicted by some to crash, it actually rose very strongly, and the following year as well. So the expectation of most analysts, Danny, I'm finding and we're scouring media every day for information and observing what's being said, I think the expectation of most analysts is that real estate is again going to be that safe and solid vehicle that's not volatile like the share market, and it's going to attract increasing interest from people for that reason.
Yeah, I had a conversation just in the hallway with one of the valuers who are on the same floor as us, and their view too is they're still seeing record sales, record numbers coming through, just even in the last few weeks. So, I do think, look, we are going through something we've never been through to this extent. I think the stimulus package that the government has put through is, particularly with the JobSafe, is that what it's called? The JobSafe?
JobKeep, I think.
Yeah, JobKeep.
Yeah.
I think that's going to certainly have an impact and probably provide a little bit of stability for some people.
Mm.
We do have some of our tenants who are probably, have rung up and said, look, my circumstances are changing. But they're also, a lot of them have been very smart and wise about how they deal with this. It's not just, hey, I don't have to pay my rent, you can't evict me. It's more about, hey, what can I do to work through that? And there's also options there for some of the property owners who may be concerned or challenged. We've encouraged them, have a talk to your bank, and the banks are hopefully coming to providing good options there for people where they might want to just go on a payment holiday for a period of time. But again, you just need to weigh up your circumstances and talk to your financier so that you're making the right decision, that you're not knee-jerk reacting, that you're, again, just looking at this whole scenario that's happening and going, okay, well, based on what's going on, yes, we are going to see a slowdown, but again, it's what we're talking about before offline. It's a slowdown in people putting their properties on the market as opposed to necessary. So we are going to see a slowing of sales, but that doesn't necessarily relate to a drop in values of properties. Some areas we may see that, but again, if those fundamentals are there, I think if you've got that long-term view, I think stick to your plan and keep working towards that.
Okay, so amid all this uncertainty and upheaval, today we're talking about a form of investment that provides quite a level of certainty and security. So perhaps first off, Danny, perhaps you could just describe how a typical, say, NDIS property works, what its purpose is, and we'll start to just work our way through the various mechanics of how someone might invest in something like that.
Sure. I mean, the NDIS is a national disability insurance scheme designed by the Australian government. So I guess assists participants, those with independent living or getting participants into more appropriate living arrangements. It's an initiative by the federal government because there's a massive issue with with disability accommodation. There's a lot of people in inappropriate housing. There's somewhere about 12,000 participants in real need of more suitable accommodation in Australia. And those numbers are the numbers that are reported talking to care providers and housing providers and those who are working in the industry. They believe those numbers will be far greater because there are a lot of hidden carers and a lot of carers who are actually not even registered within the NDIS scheme, and they're still only just going through that process.
So, Danny, that 12,000, is that the estimate of the people that who need specialist accommodation but currently can't get it?
Yes. So there are around 12,000 of those in real need of more suitable accommodation.
So there's a need that's currently not being met, and hence why there is an effort to try and perhaps ramp up the creation of that kind of property, and therefore it creates an opportunity for investors who understand how it works and can go about it the right way.
Yeah, look, we've been working within the disability sector for the last couple of years, particularly in partnership with an NDIS approved housing provider and a builder who works very closely in that process. And we're at the forefront of that in what we believe in making sure that we're providing the suitable housing. The government's really focusing on particularly people under the age of 45. They've got a goal that everyone under the age of 45 throughout Australia be out of unsuitable housing. A lot of those might be in nursing care, nursing homes, in accommodation that's completely not fit for purpose. They might be wheelchair bound, but they're having to be picked up and carried because their house is completely unsuitable for them because there's stairs and the like. And they have their push is to have those 6,000 people that they have on their books, and I believe it's a lot higher than that, into appropriate care. Then the government's not going to meet that by 2022. June 2022 is where they'd like to do that. And then by June 2025, those under the age of 65.
Okay. Danny, Tammy is just asking, and I just want to make sure that people out there watching and listening are aware that you can type your questions into the chat box or the Q&A panel, and we welcome you doing that. We'd like to have a discussion with you as we talk through these issues over the next hour. So please give us your questions and we'll respond to them as we go through over the next 45 minutes or so. Tammy's just asking, Danny, that 12,000 figure, is that national or just in Queensland? I assume that's a national figure.
That's a national number, but just even in Queensland alone, for example, there's 100, and very tragically, there's 100 people that go into the spinal care unit just through motor vehicle accidents and a variety of whether it be motor vehicle or, when I had a nasty accident 8 years ago, I was very fortunate that I didn't break my back, and we have a colleague whose partner is in a wheelchair through a motorbike accident, and so this is something that's just very much at home for us, and we see this lack of appropriate housing and appropriate care. Up until now, it's been really up to there's some small funding that people can get, but this is where the government's made a real push and have committed significant funds every year for the next 20 years to support and provide housing support within the private sector, supporting that through this scheme, through the Specialist Disability Accommodation. It's important to understand there's probably 5 different levels of accommodation that you can provide. There's one which is called basic. There's improved livability, fully accessible, robust, and high physical support. And the participant has to apply and get in the NDIS plan. They've then got to have appropriate housing added to their plan. So they get assessed, they go through an assessment process, and then they get an NDIS plan written up, which will then include the level of housing that they require for them to get the funding to which then funds the housing that they go into.
So this is something the federal government wants to happen. They want the private investment industry to create homes that are suitable for people with disabilities. So in simple terms, what's the process they'd like to see happen? An investor comes along and talks to somebody like you, and a new house is constructed according to the specifications and it's made available to people with disability as tenants. Is that sort of the simple process?
Yeah, it's probably a little bit more complicated. I think there's obviously institutional funds that are going down this path where they'll be building complexes, but the government's also got a very big, they're very big on concentration. They don't want to see a concentration of housing. They want to see appropriate housing that's integrated within the community. These are real people who have real lives, and it's allowing, rather than creating an area that's just set aside for people with disabilities or a unit complex or a group of houses, they really want to see these integrated within the community and people partaking. So for individuals, for those who want to do it, I think the key to understand, I think, is there is a very specific process. There's some very important things that you need to understand from a compliance perspective. It's not just saying, hey, I'm just going to read the livable housing guidelines that are available, which you can download on the net, and then go, right, I'm going to build a house. It's about understanding, working with care providers, with the support networks that are out there, to go, right, where do we need a house? Is this block, is this area going to be right? Okay, this block ticks all the boxes, it meets all the right levels. Great, now get a design done, that design's then gone through a process and is then ticked off and certified, and then go through that building process where we've got an actual certified SDA design and plan. Unfortunately, we're seeing, I guess, marketing companies out there promoting and builders out there promoting, hey, we've got this SDA house you can buy, and then it hasn't got its compliance. It goes through that process after the house is complete. And if there are things that aren't done right, that house will never comply.
It's got to be done right from before you even start to design and build it, doesn't it? And that's really important. And we will talk about the compliance issues as we get a little bit deeper into the discussion, Danny. But I think one of the things that to me appears to be different about this form of real estate is that there are much longer than normal leases available. It's normal, I think, for there to be perhaps like a 10 or 5-year lease on a property. Is that correct?
Yeah, look who we work with, and through the SDA housing provider we work with, it's a 10 by 5 by 5 lease. To be fair, we're only dealing in the high physical support. That's where our real focus is. So that's where we see a massive need and a massive hole, and where there's real demand. But also too is that's probably where the best returns are as well. Interesting enough for our clients. So you've got to understand, number one, where the demand is. So you're building in the right places where that demand is. But you've got to be working with those housing providers right from the start. And if you don't, you're going to get yourself in all sorts of trouble. We're even hearing, Terry, of people saying, well, look, when we first started looking at this was the direction that we were starting to head down, was the investor becomes the SDA provider. But as we investigated that, the risk for you as the investor becoming the SDA provider is incredible, because there's no statute of limitations for these people. As the provider, the housing provider is the one who has to care for and is overseen, is managing that property. So there's a level of liability. If I'm just the property owner and I am then having the housing provider do that, they're the ones, the housing provider's one bearing the risk, not me as the owner of that property. From a compliance perspective, through auditing, through managing trust accounts, it's almost a full-time job. And most people who want to invest in this sort of way of property, you really want to just set and forget, and knowing that you actually are making a difference. And having those long tenure leases, it just allows you just to sit back and not really be too worried about the constant. I mean, I think it's an incredibly safe investment, purely because it's funded by the federal government, it's paid by the federal government. It's not going anywhere, it's legislated by law. The funding's legislated, but it's got to be managed right, because if it's not managed right, you won't get that funding, it'll be taken away from you.
Now that form that you were speaking about, where there's commonly a 10 plus 5 plus 5 lease, who is that lease actually with? Is it with the individual tenant, or is it with some government entity that actually takes out the lease?
Well, it depends on how you manage it. The way we do it is through a flow-through lease with our provider, and the lease is then with the tenant, so it's kind of like a head lease arrangement with the company that's managing that, with the housing provider, and then they oversee that whole process through. So it's really a hands-off approach for me as an investor. I'm just allowing for my property manager and housing provider to be managing that process.
Actually, Andrew's just actually asked the question I've just put to you. So Andrew, I hope that answer actually responds to your question about who is actually signing the lease. So, I mean, these types of investment only have the aura of being kind of government-backed, almost government guaranteed, but I don't think that's, it's very, very important that people be clear exactly the government's involvement, because we want to make sure that people aren't misled about how these things are set up. I don't think there are any guarantees in this form of property investment, which is the case with all forms of property investment.
There's no guarantee you're going to get the rent unless you've got a tenant. But the government's very committed to supporting you through that process. So even to the point that, I mean, again, I do believe that certainly that high physical support, really once you've got a tenant, even though you've got a 10 by 5 by 5 lease, it's very unlikely that they're going to move on because of the complexities with them moving into that property. They're not just moving in. Like anyone, it's stressful moving house, particularly for people at a high physical support level. It's not just them moving, it's working with all their support networks, from their physios to their OTs to a whole variety of different support networks that will come and visit them or they will go work with. So it's important that people understand that if it's done right and you have a tenant in place and you are compliant, and it's very important that you are compliant, that you're more likely going to have a client that's going to be there for some time. The important important thing to understand is, though, that if a tenant leaves, sorry, my Siri is talking to me for some reason. It just thinks that Siri's on. Important to understand that if a tenant does leave, so if a participant for some reason has to go to hospital or they leave permanently, the government will provide funding for anywhere between 60 to 90 days, depending on what level of support you've got, to help you to find the next participant in place. So if you've got a good support team there with a really good SDA housing partner, they're constantly talking to the care providers in the community to help them bring the right person in to then fill that gap. But if you're not compliant, the government's not going to pay you. If you don't have a tenant in place, the government's not going to pay you. The government just recently changed some of their thing, whereby obviously the participant has to have their SDA housing as part of the NDIS plan. In the event that that hasn't been fully approved, but the tenant moves into that place, the government will actually backdate, once that approval comes in place, will actually backdate it to the day they moved in the house. So the government is very proactive in wanting to support this, but there is no guarantees. And I do believe that there will be a number of these houses that will sit vacant for a long time, again, because they haven't gone through the full compliance. You could be a couple of millimetres out in the width of a bedroom or a door, you're non-compliant.
Yeah. And as I keep saying, we're going to talk about that in some detail as we go through. A number of the questions that people are typing into the chat box panel, Danny, relate to how do you find the tenants who are suitable for this type of property and who are looking for this type of property?
Great question. And if you're doing this yourself, good luck, because you have to go out there. You've got to build a relationship with the care providers. You've got to prove and provide that you're going to have the support services there and that you are compliant and that you understand the industry. For me, we will only work with the housing provider, an SDA housing provider that's approved by the NDIS. They are the ones who will then have those relationships working with the care providers and the people within the community who supporting our people with disabilities in this space to ensure that they're working with. And that's why it's important to have that relationship with the housing provider, because they're going to be talking with the care providers about where there is a need. And so you're not going to be building a property in an area where, and the care providers all talk to one another. And so, they're going to say, hey, we don't want 10 houses in this little area here. We need one here, we need one here. One way over there. And so then, you're planning about where the best place for those properties to go. And for us, our housing provider, SDA housing provider, starts looking for, even though they might have a list as long as they're armed in that particular area, they're going to start doing what we call tenant matching once the slab goes down. Once we know that we started building on a property, they can then start promoting and talking to the families and to these participants saying, hey, see this slab, could be a home. For the first time in life, here is a place where you can have a home for you to be in. I was at a little seminar the other week, and we're going back a few months ago, and our builder was there, and this person in the wheelchair just came over and just held him and hugged him and just cried and just said, thank you for building my house. And you see that, you just see, it moves you, because these are people who have never had a home to their own before.
Designed for their needs, because the average 4-bedroom, 2-bathroom brick and tile home isn't suitable for the needs of people in wheelchairs and with other forms of disability.
And the cost of building, people have to understand the cost, and this is where people have to understand the cost of building this is more than double that of building a normal house. So invariably you might be spending, I don't know, $1,300, $1,200 a square metre on a single-storey house. Here you might be spending $2,300, $2,500 a square metre for the same size house, because of all the additional things that need to go into a house that comply with and required by livable housing design guidelines.
Okay. So Andrew's asking a question. I guess basically what he's wanting to know about the range of sort of costs, from small to large, and also the range of rentals from low to high that are typical with this form of property.
Well, it's a hard one to answer because the funding that you get depends on what type of property. So there is, if you're going to improve livability compared to high physical support, there's a massive difference in what the government will I guess, contribute to that person's SDA plan. But also it depends on the type of accommodation as well. So depending on what they're approved for, depends on what you get paid. There's a great, if anyone wants to email me or shoot me a message, I can send them some links and they can go on and play with the calculators that are there. On the website, or in fact, I've got a couple of fact sheets which I can send off for anyone who wants those, which covers off on a lot of what we're talking about today, both from the risks as well as just understanding the background of SDA housing. And on there's some links there which you can click onto, which you can have a look at. But invariably for us, we're looking. Let's say we're doing a 3-bedroom house plus a carer's room as well. So it's essentially a 4-bedroom house with 3 participants at high physical support. Your gross rent's going to be around about $128,000 a year, and that's going to cost somewhere, depending on the land cost, but you're going to be looking somewhere around that $800,000 to $850,000 here on the Sunshine Coast or in North Brisbane.
So clearly the build costs, as you've already mentioned, are more than building a standard comparable home, but the rentals are also commensurately higher. Therefore, the rental in that scenario, just do the sums for me. The scenario you just mentioned. What's the rental return?
So your gross rental yield is around about 17%.
17. Yeah. Okay, so there's those are a couple of important points I think for investors to be very aware of. Your build costs are higher than for a typical home, but your rental income and therefore your rental yield are also much, much higher than you can normally achieve on residential property. But it's very, very important to get it right so that you can achieve that, because maybe now's a good time, Danny, to talk about those important compliance issues because of the importance of getting it right so you don't end up with a costly property that doesn't meet the needs and therefore can't be rented out for those kinds of incomes.
Yeah. Well, there is a series of complexities that are, I guess, that are involved in the building of these properties. For us, I guess, each property needs to be registered in the scheme through an SDA provider. As I said, if you are going to become the SDA provider, there is massive risk for you because you've got to go out and you've got to help find the matching of property with tenants. You've got to go through that process yourself. You've got to ensure that you've got the auditing process in place. And if it's not handled properly, obviously there's going to be quite severe vacancy on the property. People need to understand that the SDA payments are not payable just by registering your property into the scheme, which is what we were just talking about earlier. The property owner must have a qualifying tenant in that property, and finding that tenant is the owner's responsibility. Now, for us, because we're engaging with an SDA provider, when they're becoming the property manager, we're passing that responsibility to them. As I said, there are 5 different types. There's basic, improved livability, fully accessible, robust, and high physical support. Each of those houses have certain design guidelines that need to be complied with to be ensured that they qualify for the payment and get that compliance. It's not just about building the house, it's actually making sure your block of land is right. And a lot of people, I remember talking to one person, said, I've got a block of land, it's dead flat, come in and have a look at it. And there was a couple of meters of fall. Yes, you could probably design a house to work around that, but the cost and the implications of that almost just negate their need to do that.
Okay.
And
so in simple terms, you really do need to have an expert on your team. You should not attempt to do this alone, as you might as an investor buying a block of land and building a standard house. You need to have somebody like yourself on the team to make sure that you're going through the processes correctly and end up with something that can actually fit the criteria of the scheme.
But also, you need to make sure that your plans are certified. So, if your plans aren't certified, you're running risk that your house won't actually be registered to be part of that scheme. So, there are auditors that will go out and ensure that external auditors that you meet those requirements to put your house into that quote unquote rental pool. Understand too, if you build a high physical support, you can still have someone who's fully accessible renting in your house. But if you build an improved livability design, you can't have anyone who's fully accessible or in high physical support. And so for us to mitigate that risk of vacancy by going at that highest level, yes, the cost is a little bit more to build, but in the event that you were concerned, you could always have someone working with your SDA provider, someone at a lower level of funding could still move into that house, and you could still achieve returns of over 12% if that was to employ you. There is a vacancy risk there, but if you're not following the rules, you don't go through the process working with your SDA provider at the very beginning of the process, you need to make sure your SDA provider knows what they're talking about. And understanding too that you're not going into what we talked about earlier, those concentration limits as well, where there's too many properties in a very specific area.
Yeah. Steve is asking, how long does it usually take to find a tenant? From what you're telling me, I think the sensible way to do this is have your tenant before you actually start. I think that's the way to go about it, isn't it?
No. Your tenant comes in. What will happen is they'll start tenant matching when your slab goes down. So by the time the property's completed and we've gone through and we had the property registered in an ideal scenario, and we're already, with the properties that we have under construction already, the ones that are further advanced, we've already got those tenants lined up. So once it's registered, tenants move in, and then the money will start to flow to the client.
Another question related to that, are the rents returns guaranteed by the government?
The rent that which that person is qualified for, the participant's qualified for, is not only is it guaranteed by the government while they're in the house and you're compliant, but it's also indexed to inflation as well.
Okay.
This is the federal government, by the way. This is part of the National Disability Insurance Scheme, where they've set aside funding for housing. So it's very important to understand. It's been legislated, it's law. It's not something that the government can turn around and just backflip on. Someone asked me just the other day, what if, because of all the economic doom and gloom that's out there, or the government supporting people, are the government going to just stop funding people with disabilities? If the government stops funding those people who are the most vulnerable in our society, I think we've got a much bigger problem than anything else. This has actually been passed by law, the same way the GST has been passed. All the states have to agree and have agreed to it. They've removed their responsibility and handed back over to the federal government.
Sandeep's asking a question, which I guess relates to the type of locations that these sorts of properties are typically built. Is there a generalised way you can describe the type of area, location, suburb that the government likes these sorts of properties to be built?
They want it to be built where there's demand and where there is a high need, which is then provided by the care providers. We are finding that most, not all, but tends to be a high demand in some of the more lower socioeconomic areas, partly because of all the families that are working with and have a family member that is affected by disability live in an area where it's affordable for them, because a vast majority of their income has been put aside to support their family member and their loved one. And that's also where their support services and their connections and where their relationships are. And so they want to still be within the same area of an area of familiarity with them. So areas where some people might not traditionally think to invest is where there's need. But you've got to be careful too. If you're going to be building an SDA house, you need to make sure that it's close to certain services and requirements that are required, not just by, like you need to be close, to hospitals, medical centres, but also to community facilities and parks. I mean, these are people who still want to get out and about, still want to have access to cafes, and want to still have access to public transport and the like as well. Not all of these people are going to be immobilised in a home, and never leaving that place.
Yeah. So it's important to be aware of the need to be close to certain. It's also true of other forms of residential property. You want to be close to the basics, but there are particular things that this type of property should be located near to, particularly those services that they're going to need. Andrew is asking a question there. Essentially, is there a place for the small investor when you've got institutional investors building large numbers of these things? How do the smaller owners compete with those bigger institutional type investors?
I'll answer that in 2 points, because I think we need to talk about something else, which I think Sandeep mentioned earlier as well, a question about financing, because financing is a big part of this. It's one of the big challenges that we have with the banks. But small investors can do this, and we have mum and dad investors who are investing in these properties now. You just need to be in a really strong financial position to do so. The banks are still trying to understand and get their head around. We've got a couple of banks that I've had a number of conversations with senior levels of the banks. They're still trying to work around how they get a head around it from an individual investor investing in this. It appears that you do need to invest with a corporate trustee and a trust in place, because some of the banks are going to look at this and may look at this as a commercial lend. And if they are going to look at a commercial lend, they're going to look at it with a cap rate. And if you can get the cap rate where it needs to be, it becomes a very positive experience. We've got one client at the moment, we're going through that place, and they put a cap rate of about 9.5% on it. And even then, they're being, in their words, a little bit conservative because it's still very new territory for them. A 9.5% cap rate, all of a sudden, from your net rent, all of a sudden, from a valuation perspective, you're paying significant, it's a lot higher than the actual purchase cost. But if you're doing a commercial lend, some of the banks will only do a 50% lend on that cap rate. So you're still going to be putting a couple $100,000. If you're going to a traditional lend, your valuation will, for example, the ones that we've done as a traditional lend, they've been around that $800,000 purchase. The bank valuations come back at $600,000 because they're comparing it as a residential property only and for residential use. And so they're applying the principles and the requirements that have been put in place by the bank to view that as a residential property. That same value has also valued one at close to $1 million as a commercial. So it just comes down to the way the instructions are from the bank and how the bank wants to treat that. But I always say to clients, if you've got allow about $300,000 of equity or cash to put into this. It's not for everybody. Don't get caught up in just the greed of trying to chase a big yield. We want, this is about also making a difference in people's lives. But the pain that we see at the moment, the biggest challenge that we see is working with the banks. And we've got a couple of really switched on lenders that are able to help our clients in that process and talk them through that process and give them the right advice.
So, Danny, Sandy, Bruno, and a number of others are asking questions all around that. The difficulty with lenders and also the valuation process can be a barrier. So, and they're asking the question, how do you overcome those problems?
Well, we're constantly talking to the valuers. We've got a great working relationship with Harry and Todd White here, and they're really working hard to get their head around. I don't know if I should be plugging them or not, but I don't always agree with them. And I was butting heads with one of the directors yesterday, but in the sense that they're still trying to understand and get their head around, what if you don't have a tenant, then who's going to rent it? Are there risks there? And I think it's and I understand where they're coming from, because there are people who are building these who are not going through the proper process, and they're seeing vacancy because they haven't gone through that proper compliance process. So I think that will loosen in time as they start to see real case studies come through. But at the moment, it's the clients who really are in a strong financial position that are able to take advantage of that. And even if the valuation does come in really high with the cap rate, and they've got a lower cap rate, so the valuation is a lot higher, the bank may still require you to put X amount of dollars in just for their own safety guard. But the beauty of this is, if you've got a property within 8 years or so, within 8 to 10 years, this property is fully paid off. And it's not only is it paid off, it's actually now providing a very strong passive income for you. So to me, I just really see this as a really good long-term investment where you've got those rents coming in. You might need to put a little bit of money in after 10 years just to modernise the house or update a few things. But if that house is fully paid off and you're earning, in today's money, because it's indexed, $100,000 plus net, why would you spend 20 grand 1 year to just do a little bit of reno and tidy things up? It's all about looking after those that are in there.
Glenn's asking a question which comes in a little bit later down the process, and that's about how the properties are managed and the costs of management of those sorts of properties. How's that usually handled, Danny?
Well, it's different for different providers. I mean, some providers we're seeing there typically are charging anywhere between 15 to 18%. The housing provider we work with, they charge an 8% plus an 8% fee, management fee, and then there's another 2%. So all up about 10% to manage and also do all the compliance and the auditing process for you. So again, you just got to shop around and work with who you work, make sure you're working with the right person. Again, it's something that we do, and I would suggest, I'm very confident that we do this well, and sort of the proof's in the pudding to date. As I said, the clunky part is more, I mean, our initial concern was, are we going to find the tenants, and then are we going to find the people to rent these properties? That's the least of our concerns. The biggest challenge is actually now is just how the banks are and working through that funding side of things.
And Stephen is asking, are there multiple tenants or houses built specific for one person living with a disability?
Again, depending on what type of property you build. So you could build, you might do units. Now, units defined by the NDIS is where there's property on top of another property. So the cost of building units is quite expensive because you've got to have a commercial grade lift in the property. If it's not a unit, if you built two units side by side, they classify that as a villa, and that's a different level of funding. So those may have one person, they may have two people, depending on what, again, the complexity of this is depending on what the level of funding that person has had. You might have someone who, like I might decide, I've actually got a block of land, I'm actually looking at doing this, looking at building two bedroom units, one on top of the other. The cost's going to be quite scary. I'm probably going to be looking around about $900 to $1 million to build those two bedroom units, which is very expensive. But I could potentially achieve net rent of around about $90,000 per unit with just one person in each unit. Alternatively, though, I might end up having two people in one unit because they both only achieve funding for them to share a unit with somebody else. And believe it or not, that actual yield is actually even less again. So the government has different formulas that they use, and that's on that spreadsheet that I can send through. What we're mainly focused on for most of our clients, we're doing 3-bedroom houses with the goal of having 3 participants in the house with an overnight assistance care.
Rena's asking, since the leases are long-term, are the leases registered on the title in similar ways that Defence Housing and NDIS properties were originally registered?
Not that I'm aware of, no.
Okay.
I'll have to come back to that. If he can just email me at invest@000property.com.au, I can then come back and give him an answer to that. but I'm not
Yeah.
aware that that's the case.
Moto is asking or saying that it would be good to get fact sheets and servicing calculator to understand the processes better. I think you've just mentioned that fact sheets are available. Yep. And again, can people just perhaps email you and you'll send that kind of information through to them?
You can just email me your name and your contact details, and then I'll Sharon in my office, who's working at home, she'll email through. We've got a 1-page, we've got a 2-pager, and we've also got a risk sheet. And on that, just going through the risks and just really give you a bit of understanding. We're certainly, I guess, something for your clients. Terry has a bit of a special offer where we're happy to just sit down with anybody, and well, not sit down, but we'll do a Zoom meeting or a Skype meeting with someone and just talk them through the process and answer their questions one-on-one, and happy to provide a half-an-hour session for anybody, no charge.
Yeah, I think at the end of the broadcast, Danny, we'll talk, we'll give some more detail about what should people do if they want to follow up and have a more detailed conversation with you, get more information, how they contact you and all of that. Michael was asking, how does the government support payment get to the property owner if a head lease is signed with an SDA provider? Does the provider pay the investor and then the provider is reimbursed by government? How does all that work?
Okay, I might just share, if that's all right, I've got a couple of slides that I might just go to now, which might just answer some of these questions. I've just got to find, here we go. I'm just going to share this.
Okay.
Okay, I don't know, does that come across? So I've looked here at an example purchase of an $810,000 property. It's a 4-bedroom house and land contract. Obviously, we're finding the land, we're building the property with our rent contribution, high physical support, and on the tenant, there's also a location factor depending where you are. If you've got 3 tenants, it's 0.91. If it's 2 tenants, 0.93. So with 2 tenants in play, you're actually getting slightly higher in that regard. And so that shows you the yields that you can get. Now, I've gone with the standard funding there, which I'm talking about, is 6,000. That's your reasonable rent contribution. The reasonable rent contribution comes from the tenant's disability support pension, and it's 25% of their total pension costs, which go towards it. It's a little bit higher than that. I've just do it on the lower side. And then there's situational funding, which is the SDA payment paid by the government. I've got a bit of a process which I can email out to people, which just talks about our process and how it works. So probably just looking at those last couple of points there at the bottom of the page, the property is then registered as an NDIS SDA property once it's completed. The approved SDA participants move into the property and then the payments start flowing. The SDA housing provider manages the property, ensures compliance, does the audits and the statutory trust audits, and manages the payments on behalf of the clients. This is the calculator you get to play with. Here you can see I've got house, 3 residents, high physical support, without a breakout room, on the coast, and you can see that situational funding there, the location factor of 0.91. And your total there comes down to 128,000. That's assuming no vacancy. Once we have a tenant in place, we don't seem to believe there'll be any vacancy during the course of that process. If you only had 2 residents, it's 92 gross. Now, this is probably the bit I want to talk about. The way we go through is working through the design. We monitor the build, making sure it gets registered, making sure the yearly compliance is there with our SDA provider. They manage the tenants. They'll claim the SDA payments on your behalf, and then you'll get paid. The participants have to go through a specific process. They have to have an NDIA plan. In that plan, they need to apply for SDA. A lot of participants don't even realise that they can get this support. And so in Queensland alone, last year from June to September was the first quarter people could actually add SDA housing to their plan. 1,182 people were registered to have SDA housing as part of their plan in Queensland alone in that first quarter. And there's only 82 houses that had gone through, not even built, but were just going through the compliance process. the red tape of the housing provider, they manage all that process for you. And this is probably the flowchart answering that question. The SDA registered home, the SDA approved participant, you've got your Centrelink payment, the RS reasonable rent contribution from their pension. The provider will then claim the payment from the NDIA, goes into the trust, and then it's distributed to the owner, less any fees, for example, your management fees or any other costs that may be incurred. Again, that just shows you how that flow works.
Okay. So, Danny, a couple of questions have come through about net rental return, because we have talked about rental returns in gross terms. After your cost, your management fees, outgoings, etc. What does it come down to? Often, I know there's a range, obviously, but
So for
net rental return.
Yeah, so for net, depending on how it's worked, for us, our net clients are around about 112, 116,000 on a 3-bedroom, if you've got 3 participants in a house. For example, I looked at if I have 2 people if I did a 2-bedroom unit, so I've looked at this as a 2-bedroom. Actually, if I look at we've got a client who's looking at potentially doing 4 2-bedroom units with care. If they had a single person in each unit, their gross rent would be around about 456,000 off the top of my head a year. Their net rent would be about $380,000.
Okay.
But you're looking around about a $2.5 million bill for something like that. So,
yeah.
It's that's not for the everyday person, but we're finding most of our clients who are wanting to look at this are quite happy just to do a house to start with, understand the process, and then work from there.
Okay.
But it's, again, like my view is I think if this is something you're seriously considering, I think you need to sit down and have a chat with your financier, understand how you look from a finance perspective, know what your equity position is or your cash position is. Some people might see this as high risk. The more I look at this in the current climate, I just think this is probably one of the safest investments you can make.
Okay.
If you do it right.
Yeah, I think that's one of the key points that we've emphasised again and again in this discussion, the importance of doing it right in terms of compliance. You can come a cropper, a big one, if you don't get the right advice and do it the right way.
Terry, I noticed Katie asked a question asking that, I think it was, Chris asked a question, in a 4-bedroom SDA house, potentially for 2 or 3 clients, how do you pair clients? Well, that's the job of the care provider working with the SDA provider to what we call tenant match. They'll tenant match the clients together. They'll work with those families because we've got around about a 24-week build process. So we've got about 4 to 5 months where they're working with and making sure that they're together. A lot of these people, a lot of the families already know each other. They're involved in different support networks with one another. The community is very strong and supportive. So, they will work personalities out together and ensure that that's fine. If for some reason there are people in that house and there is an issue, then the housing provider, SDA housing provider, is going to sit there and work with the care provider to then look at how they either resolve it. If it can't be resolved, then you'll find that one of those tenants will be placed elsewhere. In the interim, until that next someone else comes in, you'll still receive funding from the government. They'll pay that SDA payment for up to 90 days.
Okay. And just to respond to some of those earlier questions and concerns about the way banks regard these properties and valuers regard these properties, a point that you made to me in a previous discussion was that depending on the cap rate, the properties can be valued at considerably more than they actually cost to build.
Oh, totally. I mean, if you're looking at and again, I'll just pull out my trusty old calculator. So if you're looking at a property that, let's say the net rent is is, let's say it's an 800, just put in just a round number, $800,000 house and land, which we're actually looking at one at the moment with our builder and with the Special Disability housing provider, SDA housing provider, where they've identified a block of land where there's a need. We're in the process of getting those designs, and then obviously when the right client comes along, you're looking around about $800,000 build. Your gross rent, your net rent's going to be around about 100, and let's say 115. I said 116 before. Let's say 115. If they do a cap rate of just 9%, you're looking at about a $1.27 million valuation. And then depending on how the bank looks at that, if they do a 50% lend on that, it might be a $620,000 loan, and you've got to pay the balance. The one that we just had recently, they did some discounting on that purely because they're just trying to get their head around. They, I guess, understand the difference between this and an NRAS property, for example, where you had that National Rent Affordability Scheme. This is very different from that.
Yeah. Given that scenario you've just described, the difference between construction costs and potential valuation, why would lenders have a problem with this form of property?
Because they've never seen it before. This is all new, and it's a question we're asking ourselves every day: is why? I mean, this is for us 18 months, 2 years of real research into getting our head around this, and even then we're still learning new things along the way. For a valuer who's going to sit down and make a decision just based on in front of them, and I think their concern is that there are properties that are being built which don't comply and therefore are sitting there vacant because they can't find a tenant. And so it's for them understanding, well, how is this different from that? How is A different from B? And because they don't understand those processes, the compliance requirements that go into that. So our job has been educating some of the banks in this process and actually been educating the valuers and how they look at this and treat this. And I think, look, there are some real benefits there for the early adopters, but there's also going to be a little bit of pain in that process as well. The pain is the financing, but the benefits are being some of the first people doing this, particularly in Queensland, where we're focusing at the moment. There's a huge demand at the moment, and we see that demand continuing. And when a demand starts to shrink in a certain area, we'll be looking at the next place where we go, where we meet those demand. But numbers are still growing, and people are unfortunately coming out of the woodwork who never realised there was that support that was available to them.
Okay. So, Danny, we've just ticked over the hour, and we do try to keep these special webinar broadcasts to 1 hour, being mindful that a lot of people are watching perhaps in their lunch break and need to get back to work. For people who are interested, want to follow up, want to find out more, would like to have a further chat to you, how do they contact you?
Well, the best and easiest way is to just contact us at invest@000property.com.au. 000 is in TRIPLEZERO property.com.au. If you go to Terry's website, you'll see our panel partners there, that we're part of the panel partners there. You can just click on that and just or go to our website, fill in an inquiry form, or just email invest@000property.com.au.
And I think we always follow up a webinar by sending a copy of the broadcast to everyone who's registered. So those who weren't able to watch live will be able to get a copy and watch it at their leisure. But those who have been watching live today can have a look at it again. But we will include some follow-up information, such as how to make contact with Danny. And if you want to follow up, find out more.
I'll also send you a copy of the slides. I've got some other slides there which I've done up, which you can really get to. I'll send them to you in a PDF form, and if people want to access them from you guys as well, or I can send them out to people. Actually, I'll send them out to people who inquire.
Yeah.
that investment.
Okay. Yeah, it'd be good if you can send them through to us as well, Danny, and we can perhaps follow up to all those that's registered. There's clearly a lot of interest in this form of investment, and it doesn't surprise me. I mean, it seems to me that it provides safety, security, fantastic returns at a time when people are looking for safety and solidity, particularly the times that we're operating in. So, thank you, Danny, for your presentation. I think you've given a lot of wonderful information to people. There's clearly a lot of people interested in this type of property out there. I think that the key takeaway things is that potentially you can not only fulfill a social need on top of property for which there is a dire shortage, but also get fantastic rental returns, but only if you go about it the right way and build something that complies with all the requirements. And so it's very, very important that you get expert advice on board before you attempt this. If you go about it the right way, the rewards can be substantial. So thanks everyone for watching and listening today and participating. Thanks for all your questions. And thank you, Danny Buxton from 000 in particular, for a great presentation and lots of wonderful information.
Thank you, Terry, and thank you for the opportunity to talk about something that is such an important thing in our community.
Okay. Thanks, Danny. Thanks, everybody. Let's do it again soon. Bye for now.